Good afternoon, everybody. Thank you for joining today's webinar on D&O pre and post COVID. My name is Beth Thurston. I lead the D&O practice here at Marsh in London. I'm joined today by Wincy Chung, D&O placement leader, Vanessa Schneider, head of D&O claims, and Stephanie Manson, D&O chief client officer and head of D&O product. In the 45 minutes today, we will walk you through the state of the market, both pre and post COVID. We will explain the nature of the claims that have been commenced and the notifications that have been made relating to the pandemic. And we will give you our thoughts as to how to navigate the market and suggest some alternative risk transfer options that you may wish to consider. Now, we've already received a large number of questions and we've tried to answer many of them within our presentations. In the event that you wish to pose a question during the webinar, please note that you are all on mute. And so you can ask a question by using the Q&A button, which is most likely at the bottom of your screen. In the event that we have time, at the end of the presentation, we will endeavour to answer any questions that we haven't answered during the presentation. So with that, I'm going to hand you over to Wincy, who will walk you through the state of the market.
Good afternoon. In order to talk about the state of the market, I thought it'd be quite helpful to talk about when the D&O market began to change, why it changed, the impact it had on our renewals and your placements, and where we are today and our views going forward. So, in a nutshell, really, the D&O market really started to change back in June 2018, and initially markets really focused on those clients with US listings and US exposures, and those who were involved in industries such as life sciences, mining, media and tech. As we progressed into 2019, that shifted, and the attention also included UK retail clients right into 2020. With the London market being a market of international placements, it has a lot of opportunities on a global basis, but it's also exposed to many international risks. And so it's quite a unique platform and has therefore been affected by the dynamics of the global economy and the global regulatory environment. And why the market changed? Fundamentally, the market changed really for three main reasons. The first being the oversupply of capacity, and we've had over a decade, or up until 2018, we've had over a decade of softening rates and broadening of cover. And that's really considered a prolonged soft market. Usually soft markets would last for about 7 years, but the last soft market we've seen up until 2008 lasted more 12 to 15 years. The second point was, or it really is to do with the increased claims activity that we've seen, and it's unprecedented. So you may be familiar with the level of US securities class actions, and a lot of those are now focused on foreign filers. So those companies that are domiciled outside of the US, but with US filings. There's also a lot of more activity with US plaintiff law firms, and the cost of litigation has gone up. Prior year development is also the third and probably one of the most key reasons why we're seeing this shift in market appetite. And really, with D&O being a long tail business, so you could log a claim for some years ago, but really markets don't start to pay out until years into the policy period, post-policy period. And so what's happened is that claims that may have been noted back in several years ago, we're seeing markets having to pay out on those claims more recently, and that's affected their bottom line and affected their numbers. So those 3 points has really been the driver as to why the market has changed. Could we shift to the next slide, please, Beth? On this slide, we're going to talk about the impact of those changes. So what's happened is that we've seen big rate changes, significant retention changes, and significant capacity reductions. So those three markers are really the markers that markets have been using to try to correct their books. So as you may have experienced from your recent renewals, you would have seen quite significant rate increases. Markets have also pulled back in capacity. So where you may have had markets giving out 25 million lines, that's a very rare condition to have. So really markets have cut their lines back typically by about 50% since 2018. And retentions have also gone up. So that's another way that the industry has been trying to manage their risks. What we have also seen on the back of this is that the appetite for side C claims or side C coverage, i.e. the SEC type coverage, has been in high focus, and markets tend to look at the attachment levels in terms of where they previously may have attached. So where markets may have attached at low levels, excess of 10, etc., they're pushing their attachments up, and many markets are now looking at minimum attachments of 50 million. Also A-side claims, i.e. the claims for the individuals, that kind of area has also been under a lot of attention, and with the increase in shareholder derivative class actions, again, a lot more scrutiny around that coverage. So looking forward into 2020, given the levels of uncertainty that already existed pre-COVID, so the claims environment, there's in terms of the claims environment and the added shift in terms of social inflation, ECG type matters, the societal shift whereby the public are wanting to hold corporations accountable for any wrongdoing they feel has happened, and the added insolvency type risks plus COVID uncertainty has heightened the level of uncertainty in this market and within the industry itself. What we are then also seeing added to this mix is a high focus on coverage. And really in terms of coverage, we're seeing markets pull back in discovery options, i.e. where we may have previously got pre-agreed discovery options. Markets are now reluctant to give those. We're also seeing added exclusions such as bribery and corruption, insolvency exclusions, and bodily injury type exclusions. I will take 1 minute just to talk about the COVID exclusion that a number of people have been talking about. So COVID exclusions in the D&O space are not typical. We've only seen one market that are applying these exclusions as a matter of course. The rest of the market are not. It's not deemed appropriate for long tail business such as D&O at this present time. We are seeing them on short tail business such as property lines of cover, where they are more typical, and we don't expect to see these types of exclusions in the D&O space. However, markets are generally asking more questions around COVID preparedness and trying to understand what our clients are doing to prepare for this pandemic and going forward. So with the heightened risk selection and scrutiny around their underwriting appetite, we are seeing markets quite hesitant in underwriting new risks in some cases, and really having to go through a number of levels of management to get sign off for the higher risk clients. And those in this environment have expanded into hospitality, travel, automotive type industries and retailers. So Beth is going to touch on the various rate changes that we've seen in the last few months. And this slide is the state of the market slides, and so it really gives you a summary of the changes that we've seen over the last year or so in terms of change in litigation environment, capacity management, insurers' withdrawal from the market or reduction in capacity, retention increases, and these significant changes in appetite. So Beth, if you want to talk about the rate changes.
Yeah, Thanks, Wincy. One point that I will mention in relation to this slide is Wincy's obviously painted a pretty stark picture of the market volatility and the current state of the market. You'll see at the top of the pyramid, there's a question, which is new capital question mark. There is one small green shoot, certainly at this stage in the London market, with one new insurer looking to write financial lines with a focus on commercial D&O from July of this year. It remains to be seen whether there are other new entrants into the marketplace. So for those of you who dialed into the Marsh General State of the Markets update a couple of weeks ago, you will have heard me say that in Q1 we saw triple-digit increases across the majority of our portfolio. I'm now going to show you some of the data from Q1 split into different segments. So this first analysis shows average price movement on a quarterly basis for our public company portfolio. So across all public companies, despite them seeing a 49.8% increase on average for their renewal in Q1 2019, they also saw a further 169.8% increase in price in Q1 2020. The next data set shows our Ftse 100 portfolio average price movement, as you will see, with a 170.5% increase in Q1 2020. Now, what this data doesn't show is the additional impact on renewals that Wincy has just mentioned. So many of the accounts that renewed in Q1 also saw a significant increase in retention. Many of those accounts were restructured, and some of them had a reduced overall limit, and those additional factors are not taken into account in these data sets. This looks purely at price movement per account. The next slide shows our Ftse 350 portfolio, which actually is the sector that historically was considered by underwriters to have one of the more benign risk profiles. But you'll see even within this sector, there was a 155.2% increase in price on average for renewals in Q1 2020. The final data set details, in fact, the only segment to show double-digit increases, which is our private company portfolio. The average increase in Q1 for private companies was 34.8%, which in any other environment would still be considered to be very significant. So by any standards, the impact of the market conditions is extremely challenging, and you will need to be well prepared for your D&O renewal for some time to come. Stephanie will shortly give you some guidance as to steps that you can take to mitigate the market volatility. But before that, Vanessa is going to talk you through the COVID claims environment.
Thank you, Beth. So Wincy has already talked about the state of the D&O marketplace and has commented on the deterioration seen pre-COVID as a result of the change and regulatory landscape faced by senior executives. The pandemic has unfortunately exacerbated this, as insurers saw immediate claims impact from the pandemic. We thought, therefore, it would be helpful to look at the type of claims that we have seen so far. To this end, we've looked at, firstly, formal proceedings that have already been brought relating to the coronavirus pandemic, specifically shareholder actions brought in the US, and secondly, notifications that have been made to Marsh D&O policies. Based on this, we will give you our view as to what the claims landscape in the future might look like. And finally, we will give some guidance as to the key points to consider if you have to notify a COVID-19 D&O claim in the future. The position with regards to formal proceedings is obviously continuing to evolve, but the first US class action related to COVID-19 was filed in March, and since then there have been claims filed against at least 8 companies and all of their directors and officers in the US. One further class action related to COVID-19 has been filed since this table was produced. The majority of the claims are securities class actions, although a shareholder derivative claim and an M&A class action have also been filed against companies and their directors. Those of you who have a knowledge of D&O proceedings will no doubt be aware of the increase in event-driven litigation, and so you might not be surprised to hear that proceedings were quickly commenced in the US. The nature of the cases is fact-specific and the proceedings are at an early stage, but there are some broad trends in the allegations. Namely, firstly, allegations relating to disclosures, a failure to disclose, or false or misleading statements in relation to the impact of coronavirus on the business, or the ability of the business to cope with the impact. Secondly, allegations in relation to false or misleading statements in relation to products related to COVID-19. It remains to be seen whether the shareholder plaintiffs are successful in these cases, but nonetheless, it gives an insight into the type of actions that could be brought, and they are a timely reminder of the importance of fully considered company statements and disclosures in relation to the impact of COVID-19 on your business. Whilst these cases are in the US context, and therefore some of you operating outside of the US may consider that you are unlikely to face similar proceedings, our experience to date is that companies globally are facing a significant potential D&O exposure to COVID-19. Can we move to the next slide, please? In that respect, based on notifications we've seen so far in the UK, the D&O and employment practices liability policies are some of the financial lines policies most affected by coronavirus-related notifications. It's notable that we have seen more notifications of circumstances than claims. However, the number of claims is increasing. Thus far, we've seen notifications relating to two broad categories. Firstly, the management response to the pandemic, and in particular relating to changes in employment and or working practices and procedures, including, for example, reduced working hours, unpaid leave or redundancies, which is of course something many businesses have had to implement quickly and in the context of varying governmental protocols worldwide, as well as differing employment laws globally. These notifications are being made to both employment practices liability policies as well as D&O policies, which could potentially also be affected to the extent that allegations target senior management. We've also received claim notifications detailing employee concerns about health and safety amidst the pandemic. For example, their access to PPE or training and other protocols in relation to dealing with the pandemic. Secondly, the economic impact of the pandemic. We've seen notifications relating to financial performance, including regarding revenue forecasts and potential solvency issues, with clients seeking to notify these situations as circumstances which could give rise to a claim. These are, of course, perhaps some of the immediate concerns which businesses are facing. And furthermore, these are arising from some of the sectors most immediately affected by the pandemic, such as the aviation, retail, hospitality, and healthcare sectors. It's also worth noting that issues are arising for clients in the UK, but also in the US, Canada, and across Europe. Based on our experience of notifications so far, D&O policies are already responding to some claims as cover is being sought for pre-claim costs, such as mitigation costs or crisis loss expenses. That is PR expenses in dealing with a crisis situation, such as the departure of key executives or debt restructuring leading to a significant share drop. We've seen a number of cases where these costs are being paid by insurers. And it's an important point to note, particularly in times when cash flow for many organisations is a key focus. The picture is a developing one, and only time will tell which areas of risk may give rise to the most claims and the highest exposure to businesses. Can we move to the next slide, please? Broad areas of risk are emerging, however, and this is fed into our view of the likely claims landscape going forward. We expect the number and type of claims notifications to D&O policies to continue to increase as businesses and individuals take stock of their position. Many businesses and individuals worldwide have, of course, been, or still are, in survival mode. Summing up the specific areas of risk then, firstly, investor claims. As we've already seen with the shareholder claims arising in the US, investors will be putting the company and board actions, statements and disclosures in response to COVID-19 under the spotlight. Investors will be looking closely at the adequacy of the company's disaster contingency planning. How prepared was the company to respond to the pandemic, for example? and to continue operations via remote working or online trading? How resilient was the company's supply chain to the effects of the pandemic? Secondly, there may be insolvency-related claims over the mid to long term as the pandemic takes a toll on the financial performance of businesses, notwithstanding temporary governmental measures relating to insolvency laws, such as those announced by the UK government in March, not least as, for example, directors' duties under the Companies Act still apply. Employees are likely to be another source of claims, as we've already highlighted, both in relation to health and safety in the workplace, but also in relation to changes in work practices, which may, for example, give rise to allegations of discrimination, which may affect employment practices liability policies, but could also affect D&O policies to the extent that allegations are made against directors or officers. Employee mental health may also be a risk, and with many jurisdictions now allowing class action type or group litigation, such allegations have the potential to become significant in the event that a large class or group of employees is involved. Of course, regulatory action may also emerge over time as enforcement actions are taken regarding the failure of companies to have adequate contingency plans in place. For example, senior managers could face scrutiny under the Senior Managers and Certification regime, or failures in compliance with health and safety laws and regulations. For example, the Health and Safety Executive could take action against senior executives for serious and continued failures in protecting a workforce. Finally, for today, is the potential for third-party claims, such as claims for breach of contract. For example, companies will be taking a close look at the force majeure clauses under applicable contracts, or claims by customers in relation to contracting COVID-19 on company premises, which claims may also focus on senior management. Can we move to the next slide, please? To the extent that claims arise, the Marsh recommendations in this situation are that you engage early with your insurance broker and insurers. This will assist with complying with the terms and conditions of your policy, maximising your potential recovery under the policy, and also overcoming any coverage or renewal issues at an early stage. In terms of specific actions you can take, ensure you have reviewed the notification language and you are clear as to when something needs to be reported to insurers. Consider whether a matter is a circumstance or a claim. Generally speaking, a circumstance is a situation which may give rise to a claim. Circumstances are generally matters which can be notified to a policy, and if accepted by insurers, any subsequent claim arising out of those circumstances or sufficiently related will then be deemed to attach back to that notification, even if the claim is actually brought at a later date. Notifying circumstances can be helpful, particularly if renewal terms may be more restrictive than your expiring policy. For example, certain covers are withdrawn, additional exclusions applied, or even lower limits purchased. And as Wincy has mentioned, insurers were already looking to apply more restrictive cover pre-COVID, and the expectation is that there will be a continued focus on policy terms and conditions. Consequently, the consideration of whether to make a circumstance notification pre-renewal will be even more relevant. In order for a circumstance to be accepted under a policy, however, insurers will be looking for a degree of specificity in what the circumstances are that could give rise to a claim. And the policy will often require details such as the identities of potential claimants, details of the potential wrongful act, and the potential insured persons involved. In the current climate, with insurers facing huge exposures to COVID-19 on other business lines, as well as financial lines products, insurers are unlikely to be generous when assessing whether or not to accept a circumstance notification, and any blanket notifications, that is, very broad notifications seeking to advise potential claims in any way related to the coronavirus pandemic, are particularly likely to be under scrutiny or potentially rejected by insurers for lack of specific detail. Consequently, again, we'd recommend engaging with your broker to understand if there is sufficient information to satisfy the notification requirements if you are considering a circumstance notification. It's also important to engage early to maximise your recovery under the policy in relation to any pre-claim covers, such as mitigation costs and crisis loss expenses, as we've touched upon previously. It should be noted that these covers usually require prior consent to be sought. So again, it's important to engage early to explore whether these covers may apply, and if so, to seek consent from insurers ahead of incurring any costs. It should also be remembered that to the extent that there is an actual claim under the D&O policy, notification will often need to be made as soon as reasonably practicable, and prior consent will again need to be sought for costs to be incurred. The other key point is that engaging closely with your insurance broker and your insurers in relation to a claim will also assist with working through any potential coverage issues as quickly as possible, given that in these difficult times, getting insurance payments may be more critical than ever for your business. It's also worth noting that to the extent that notifications could also have an impact on renewal, engaging early in the renewal process may assist with overcoming any questions or concerns that insurers may have in relation to the claim. The key message, therefore, is that in the current difficult climate, close engagement with your insurance broker and insurers in relation to the D&O policy is absolutely critical to get the best possible outcome in relation to a recovery under the policy, as well as in relation to your renewal. And with that, I'll hand over.
Thanks, Vanessa. Right. So, understanding the market and being aware of the claims environment should give you some indication of the challenges, if you didn't know already, that you will face. But before Stephanie talks you through steps to mitigate that impact, which I imagine is part of today's webinar that you're all waiting for, I thought I would just very quickly touch on the high-level categories of risk that underwriters will consider at renewal. Many of you will have seen a form of this slide before, as in the State of the Market webinars, pre-COVID, there were 6 boxes on this slide. First, insurers will consider the jurisdictional exposure. Now, predominantly that relates from the point of view of the location of any listings, with listings in the US and Australia being of particular focus due to the volume of class action activity in those jurisdictions. Insurers will also consider industry sector. Both Wincy and Vanessa have talked on industry sector exposure. And the fact that post-COVID, that has now broadened to include a number of other sectors. Insurers will also consider past claims activity, by which I mean both the claims that have occurred and how those claims have been managed by your organisation. The financial stability of an organisation was always a concern for insurers, even pre-COVID, due to the increased exposure that D&O insurers will face in an insolvency situation. Then in addition, since the beginning of the transitioning market, insurers have looked at the historic pricing of a programme. And in fact, those of you that have benefited from the most competitive pricing historically have seen some of the largest percentage increases in recent times. And everybody, unfortunately, has been impacted by the market correction that has taken place since 2018. Post-COVID, there are 2 additional categories of risk that insurers are concerned about. The first is pandemic preparedness that Vanessa has touched on. So what steps has the organisation taken both to prepare for and deal with the pandemic situation? And now the greatest focus of concern is around the long-term economic impact of the global shutdown and the potential insolvencies that may result. So with those high-level categories, and I'll whiz through them so I can pass you over to Stephanie to talk about what you all want to hear about, I'm going to pass over and then she can talk about steps to take to mitigate the impact of the challenging market conditions.
Great, thank you, Beth. So in this slide just takes you through kind of the road that we're on to a good D&O renewal. Historically, the soft market, people did not have to spend a lot of time necessarily on their D&O renewal to get a good result. But in the current market that is transitioning, and in some areas of D&O well transitioned at this point, there are a number of key strategies that will help you to get the best possible result out of your D&O renewal. So I'm going to talk through a few of these now, and a couple of them will go into greater detail on some following slides. So the first tip is just to start as early as possible. It is really important to have a strategy going into your D&O renewal and spend time thinking carefully about what you would like your D&O renewal to look like and the various options available to you should that not be possible in the current market. So start as early as possible, sit down with your broker and advisor and just talk through the current market situation, what Wincy was talking about as it specifically relates to your company and your industry. Similarly with the claim situation, and then those 8 categories of risk that Beth just spoke about. So start really early thinking about essentially doing a good underwriting on yourselves before presenting your risk to the market. The next one is related to that. It's dedicating time and resource to your D&O renewal. To get the best possible result out of the market is going to take time and effort, both on your broker's part, but also on your part, to get together the information required to make sure, again, you have that strategy in place ahead of time. You're going to need to dedicate some time and internal resource to your D&O renewal. Related to that is step number 3, involve senior management. The more people you can involve with the relevant expertise in the areas of concern for underwriters, the more likely you're going to be able to differentiate yourself from other companies in the same industry, companies with the same claim. Again, thinking about those 8 categories of risk that Beth was speaking about. Who in your organization is best placed to speak to those categories of risk to give underwriters the confidence they need to select your company as the company they want to put their capital against in this difficult time. So number 4, again, it's all related. Be proactive. So not to wait for insurers to ask questions, not to wait for increases to come your way, but to plan ahead of time. So to make sure, certainly with regard to COVID-19, there are a lot of questions that are being circulated in the market. Get in front of those questions, gather them together, get your experts ready, be able to tell your story, and that will serve you well so you're not taken aback by those questions when they come. Number 5, consider your limits. We'll get into in some more detail in a bit, but certainly Wincy painted a pretty dire picture about capacity in the market. And certainly if you buy a significant amount of insurance for your Ds and Os at this point in time, you may not be able to purchase that in the commercial market, and certainly not at the prices you were able to last year or in previous years. So you need to have a strategy around that. And similarly, budget for material cost increases. Now, no one likes to hear this message. No one wants their insurance to cost more. And all of these strategies will help you to get the best possible results, but ignoring the general market condition is not going to serve you well. So to the extent that you're going to continue to purchase D&O insurance in the market, you need to think seriously about what your budget is and budget for material increase, so you're not caught out at the end of the day. 7, 8, and 9 here, we're going to talk in a bit more detail on some future slides, just about how to go about structuring your program and where to place it. So I'm going to skip over those quickly, but they're important steps. And then number 10 is just about planning. It's making sure you have plan A, plan B, plan C, plan D, and not just a plan for this year, but a long-term plan. Certainly when we were having conversations with insureds in Q3, Q4 last year, we saw a hardening market. We saw insurers pull capacity, but certainly for insureds that were renewing end of March, beginning of April, they were facing a dramatically different situation with the rise of COVID-19. So certainly the best laid plans, the world can change rather quickly. So it's good to know that you have backups and alternatives in place for your D&O program. So with that, can we move on to the next slide? So this is just a example of a D&O tower that I'm going to use to illustrate a few different strategies you can use. Now I'm going to talk about 2 different categories of strategies for your D&O renewal. This first slide is about strategies within the traditional insurance structure. So this is just where you're going and you're buying D&O insurance from the market. What can you do to help improve your result in that situation. So a few bits of D&O jargon before we get into this. You'll see at the bottom there, it talks about side A, side B, and side C. These are D&O insurance terms for the various aspects of cover of D&O insurance. So side A are those claims against directors, officers, or other individuals covered under the policy where the company itself is not able to indemnify those individuals for claims against them. So this is the part of the policy that responds when the Ds and Os really have nowhere else to turn. So in many ways, for individuals, this is the most important part of the policy. Now, side B also just insures those claims against individuals, so claims against individual people, but for those circumstances when the company can indemnify them. So in those circumstances, the policy is actually reimbursing the company for their indemnification of those directors and officers. Now, this is probably the most common type of claim, particularly in the UK, where we have the Companies Act allows for very broad indemnification. And then finally, side C is the portion of a D&O policy mainly for public companies, but you can have this cover for private companies as well, that is mainly used in the public company context for a securities claim against the company. So when Vanessa was talking about those claims filed in the US, all those securities class actions claims were claims generally against both the company for violation of securities laws and against named directors and officers for violations of the same securities laws. So the side B and side C portions of the policy would be triggered in that case. Now, she also talked about one claim that was a shareholder derivative claim, which is a claim brought on behalf of the company. In that case, it's generally the company cannot indemnify directors and officers. So for that claim, the side A portion of the policy would be triggered. So you can see already with the few COVID-19 claims that have been publicly filed, each portion of the D&O policy could potentially be triggered. So what can we do? So the first thing, we're going to start at the bottom here. You can take a higher retention. So what do we mean by taking a higher retention? Wincy was talking about some insurers having minimum attachment points. Some insurers won't attach below 50 million, some insurers will attach before 100 million. So to make a difference, that retention needs to be significant. So we're talking 1 million, 5 million, 10 million, 25 million, that level of change in retention that will make a significant difference in how your policy is structured. We talked about limit management, so reducing your overall limit. This theoretical insurance policy here has 220 million in D&O coverage. That may or may not be possible in the current market, given the risk factors of any given client. So think seriously about what overall limits are possible, what price you're willing to pay for the limits. So this is a bit of a question about what do you want to prioritize? Do you want to prioritize your limits, or are you concerned about the cost of those limits? And then the mix of A, B, and C. You can see this particular program has quite a mix. It has 5 layers up to the 4th excess there that provide side C coverage, and then that coverage drops off. That is typically the most expensive portion of the policy. So maybe you want to reduce that part of your program. So this just shows an explanation of the different way you can structure the different parts of the program. And then finally, you may want to consider moving to just a side A only program. So that's essentially taking away all the protection for the company's balance sheet for D&O. So that's no coverage from the insurance market for securities claims or for those claims where you can indemnify, but those claims that are most important, where the directors can't come to the company for an indemnity, they would still be covered. Certainly for companies who are in difficult industries or who are having particularly difficult times, that is a good option for their renewal. And then there's also some strategies for when you have limited options, which we don't really have time to go into great detail here, but certainly things about kind of extending your aggregate rather than renewing for a fresh new limit, invoking a discovery period, or looking at co-insurance where you take on a portion of the insurance for each claim are all options when you have very difficult renewals. And with that, can we go to the next slide, Beth? Maybe, maybe not. There we go. And then the second category here, once you've exhausted everything you might want to do or might be able to do in the current environment in the commercial insurance market, or you're simply not happy with what the commercial insurance market has to offer, there are other options. Now, here are a few other options. We could probably spend a whole 45 minutes talking through these, so I won't spend tons of time on them, but we just want you to know that there are some things out there that people are talking about, and certainly that we're discussing with our clients. For the B and C portions of the program, you can put those in a captive. So if you have a pre-existing captive, certainly if you're thinking about taking a much more significant retention, one option is to put that into your captive. Now, I say the BC portions because there are concerns about putting that A side portion into a captive. Lots of these, and we can discuss the merits of them separately from this forum, but certainly it's unclear whether a group-owned captive is able to respond in those situations where the company is legally prohibited from indemnifying. Is that just seen as another way of the group indemnifying the director? There are potential conflict of interest concerns. If the director is in conflict with the company, is the director comfortable with essentially a group subsidiary making the decision about their coverage? And certainly solvency concerns. If the group is solvent, what does the captive solvency look like? And can the director be sure their claim is going to get paid? So for those reasons, we don't typically recommend Site A in a captive that's owned by the same company. However, the protected cell captive is a possible solution for these types of claims. And a protected cell that is owned by a third party and is also governed by a third party. So a number of those concerns that we have in a group-owned captive are at least mitigated in a protective cell captive. This is a solution that we're actively working on for a number of clients. Some clients have affirmatively taken this option. So this is something that is on the table now that you can use. Two more slightly blue sky options down there at the bottom. Is this a time for some of you who have similar risk factors, who are tired of the volatility in the commercial market, to think about forming a mutual? I will leave that to you to discuss. And then there is also the possibility of an irrevocable D&O trust. So essentially setting aside a pot of money in a trust for D&Os to access in the event of a claim. That is largely untested and unexplored, but it is a theoretical possibility. So we just want to leave you with the thought that it's a difficult market. There are lots of problems, but there are plenty of solutions and strategies to get the best possible result. And with that, I'll pass it back over to Beth.
Thank you, Stephanie. Now, Stephanie has done the timing absolutely brilliantly, so we're now at 3:45, but that does mean that we don't have time to respond to the additional questions that have come in live during the webinar this afternoon. So apologies for that, but thank you all for joining the webinar today. I hope that you found the commentary useful. If you would like additional information, or if you would like us to respond to the questions that have been additionally posed, or any questions posed before the webinar that you feel were not responded to in the presentations, please do reach out to us via your usual Marsh contact. We will circulate the slides via email shortly. And with that, I'm going to let you all go and wish that you all have a very pleasant rest of the day. Thank you.